Property and Casualty Exam Prep Audio Download. Question 1. The clause that requires an insured to carry a specified minimum amount of insurance, or face a penalty in the event of a partial loss, is the option A. Subrogation clause, option B. Appraisal clause, option C. Coinsurance clause, option D. Abandonment clause. The correct answer is option C. Coinsurance clause. The coinsurance clause encourages policyholders to insure their property for a value reasonably close to its full replacement cost. If they do not, a penalty is applied to partial loss settlements. Question 2. A temporary agreement providing immediate coverage until a formal policy is issued is called a option A. Endorsement, option B. Binder, option C. Warranty, option D. Rider. The correct answer is option B. Binder. A binder is a temporary contract of insurance, typically issued by an agent with binding authority, to provide immediate protection. Question 3. A mortgage clause in a property policy, option A. Protects the insurer from bankruptcy, option B. Protects the lender's financial interest in the property, option C. Reduces the insured's premium, option D. Eliminates the need for a deductible. The correct answer is option B. Protects the lender's financial interest in the property. The standard mortgage clause protects the mortgagee, lender, by giving them rights under the policy, such as receiving loss payment and notification of cancellation, even if the insured violates a policy condition. Question 4. The maximum amount an insurer will pay for a covered loss under a policy is the option A. Deductible, option B. Premium, option C. Limit of liability, option D. Coinsurance amount. The correct answer is option C. Limit of liability. The limit of liability, policy limit, defines the cap on the insurer's financial obligation for a specific coverage. Question 5. Uninsured motorist, UM, coverage in a personal auto policy typically covers option A. Damage to the insured's car caused by a hit-and-run driver, option B. The insured's medical bills caused by a driver with no insurance, option C. Theft of the insured's vehicle, option D. Damage to the insured's home from a car accident. The correct answer is option B. The insured's medical bills caused by a driver with no insurance. UM coverage stands in place of the at-fault driver's missing liability insurance, paying for bodily injury to the insured and passengers. Property damage from a hit-and-run is typically covered under collision. Question 6. An insured hits a deer on the highway, causing significant front-end damage. This would be covered under option A. Collision, option B. Other than collision, comprehensive, option C. Uninsured motorist, option D. Liability. The correct answer is option B. Other than collision, comprehensive. Impact with an animal is specifically listed as a covered peril under other than collision, comprehensive, coverage, not collision. Question 7. The amount an insured must pay out of pocket before an umbrella policy begins to pay a covered loss is known as option A. A deductible, option B. A premium, option C. Self-insured retention, SIR, option D. A copayment. The correct answer is option C. Self-insured retention, SIR. Umbrella policies often have a self-insured retention, which applies when a loss is covered by the umbrella but not by an underlying policy. The SIR must be satisfied before the umbrella policy pays. Question 8. The method of loss valuation that deducts for wear and tear and ages. Option A. Replacement cost, option B. Market value, option C. The agreed value, option D. Actual cash value, ACV. The correct answer is option D. Actual cash value, ACV. Actual cash value is calculated as replacement cost minus depreciation. It represents the item's fair market value at the time of loss. Question 9. The oldest known type of insurance is option A. Life insurance, option B. Ocean marine insurance, option C. Auto insurance, option D. Fire insurance. The correct answer is option B. Ocean marine insurance. Ocean marine insurance, which began with ancient maritime loans like bottomry, is recognized as one of the earliest forms of insurance. Question 10. The penalty of a surety bond is the option A. Premium paid for the bond. Option B. Maximum amount the surety is liable for. Option C. Punishment for not buying insurance. Option D. Interest rate on the bond. The correct answer is option B. Maximum amount the surety is liable for. The penal sum or penalty of the bond is the limit of the surety's liability, the maximum dollar amount for which the bond is written. Question 11. Medical payments coverage in a personal auto policy, Part B, pays for. Option A. The insured's legal defense costs. Option B. Damage to the insured's vehicle. Option C. Reasonable medical expenses for the insured and passengers, regardless of fault. Option D. Lost wages of the other driver. The correct answer is option C. Reasonable medical expenses for the insured and passengers, regardless of fault. MedPay is a no-fault coverage that pays for medical and funeral expenses arising from an auto accident. Question 12. A producer makes a false, maliciously critical statement about another insurer's financial condition with intent to harm them. This is an act of option A. Twisting. Option B. Misrepresentation. Option C. Defamation. Option D. Coercion. The correct answer is option C. Defamation. Defamation includes oral, slander, or written, libel, statements that are false and intended to harm the reputation or financial condition of an insurer or producer. Question 13. A host liquor liability claim would arise from an injury caused by a guest who was served alcohol at your home. This is typically covered under which section of a homeowner's policy? Option A. Coverage of dwelling. Option B. Coverage E. Personal liability. Option C. Coverage F. Medical payments to others. Option D. It is always excluded. The correct answer is option B. Coverage E. Personal liability. Host liquor liability is covered under the personal liability section, provided the insured is not in the business of selling, serving, or furnishing alcohol. A bar owner, however, would need a separate commercial liquor liability policy. Question 14. What is the term for a condition that increases the likelihood of a loss occurring? Option A. Peril. Option B. Risk. Option C. Hazard. Option D. Indemnity. The correct answer is option C. Hazard. A hazard is a condition that increases the probability or severity of a loss. A peril is the actual cause of loss, like fire or wind. Question 15. A commercial general liability, CGL, policy's coverage covers. Option A. Personal and advertising injury. Option B. Medical payments. Option C. Bodily injury and property damage. Option D. Employee injuries. The correct answer is option C. Bodily injury and property damage. Coverage is the core of the CGL, ensuring the legal liability for bodily injury and property damage caused by an occurrence to which the policy applies. Question 16. Which of the following best defines a pure risk? Option A. A situation involving the possibility of both loss and gain. Option B. A situation involving the possibility of loss or no loss. Option C. A situation involving the possibility of gain or no gain. Option D. A situation involving only market volatility. The correct answer is option B. A situation involving the possibility of loss or no loss. Pure risk exists when there is a chance of loss but no chance of financial gain. These are the only types of risks that are typically insurable, unlike speculative risks which involve a potential for profit. Question 17. The person who evaluates the extent of a loss and negotiates a settlement is a N. Option A. Underwriter. Option B. Producer. Option C. Actuary. Option D. Adjuster. The correct answer is option D. Adjuster. An adjuster investigates, verifies, and determines the amount of an insurer's liability. They can be staff employees, independent contractors, or public adjusters representing the insured. Question 18. A policy with a per occurrence limit of $1 million will pay no more than this amount for. Option A. All claims made in a single year. Option B. Any one claim arising from a single loss event. Option C. All claims from a single insured. Option D. The legal defense costs only. The correct answer is option B. Any one claim arising from a single loss event. The per occurrence limit caps the insurer's payout for all damages arising from a single occurrence, regardless of the number of claimants. This is distinct from the aggregate limit, which is the maximum for all occurrences in a policy period. Question 19. A surety bond is a guarantee that option A. The principal will perform their obligation, backed by the surety's financial strength. Option B. An insurance policy will pay a claim. Option C. An employee will not be injured on the job. Option D. Stock prices will increase. The correct answer is option A. The principal will perform their obligation, backed by the surety's financial strength. A surety bond is a three-party contract, principal, obligee, surety, where the surety guarantees the principal's performance or honesty. The principal is ultimately responsible for repaying the surety. Question 20. While the insured is on vacation, a water pipe bursts in their vacant home, causing extensive damage. Coverage for the water damage is option A. Always covered. Option B. Excluded, as the home was vacant for more than 60 days. Option C. Covered only if the insured had a flood policy. Option D. Excluded, as water damage is always excluded. The correct answer is option B. Excluded, as the home was vacant for more than 60 days. Many HO policies have a vacancy clause that suspends coverage for certain perils, including vandalism and accidental discharge of water, if the dwelling is vacant for more than 60 consecutive days. Question 21. All of the following are duties of the insurance commissioner, or director/superintendent, except option F. Enforcing insurance laws. Option B. Licensing producers. Option C. Setting the exact premium rates for all lines of insurance. Option D. Conducting investigations of unfair practices. The correct answer is option C. Setting the exact premium rates for all lines of insurance. The commissioner oversees the industry, but generally does not set rates, except in some states for specific lines like workers' comp. The role is to review and approve or disapprove rates filed by insurers to ensure they are not excessive, inadequate, or discriminatory. Question 22. A person slips and falls in a grocery store parking lot. This is an example of which type of liability exposure? Option A. Products liability. Option B. Completed operations. Option C. Premises and operations. Option D. Contractual liability. The correct answer is option C. Premises and operations. The premises and operations exposure covers the ownership, maintenance, and use of the insured's premises and the business operations conducted there. Question 23. The section of an insurance policy that contains the insurer's promise to pay for covered losses is the option A. Declarations page. Option B. Insuring agreement. Option C. Conditions section. Option D. Exclusions section. The correct answer is option B. Insuring agreement. The insuring agreement is the core of the policy, outlining the scope of coverage and what the insurer agrees to do in the event of a loss. Question 24. An employer is held responsible for the negligent acts of an employee performed within the scope of their job. This legal concept is option A. Absolute liability. Option B. Contributory negligence. Option C. Vicarious liability. Option D. Contractual liability. The correct answer is option C. Vicarious liability. Under the doctrine of respondeat superior, a vicarious liability relationship exists, making the employer legally responsible for its employees' on-the-job negligence. Question 25. An insured rents a hotel room after their home is damaged by a covered fire. The cost of the hotel above their normal living expenses is covered under option A. Part A. Dwelling. Option B. Part B. Other structures. Option C. Part D. Loss of use. Option D. Part E. Personal liability. The correct answer is option C. Part D. Loss of use. The loss of use coverage, coverage D, includes additional living expenses, paying for the increase in costs to maintain a normal standard of living, such as hotel and restaurant bills.